Ladies and gentlemen, on behalf of the City Equities team, I welcome you all to the second quarter FY23 earnings conference call of Delhivery Limited. From Delhivery's management team, we are joined today by Mr. Sahil Barua, the MD and Chief Executive Officer, Mr. Sandeep Barasia, ED and Chief Business Officer, Mr. Amit Agarwal, Chief Financial Officer, and Mr. Varun Bakshi, the Head of Investor Relations. Before we start, we would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. Kindly note that this call is meant for investors and analysts only. If there are any representatives from the media, we request you to drop off this call immediately. As a reminder, all participant lines will be on the listen-only mode, and participants can use the raise hand feature to ask any question post the opening remarks. Please ensure your name is visible as first name, last name, followed by your organization name for us to be able to identify you before we take your questions. I thank the management team for providing us the opportunity to host this call. I now invite Mr. Sahil Barua to take us through the key highlights for the quarter, post which we open the floor for Q&A. With that, over to you, Sahil.
Thank you, Rishi, and thank you to the City team for organizing this. Just a quick check that I'm perfectly audible.
Yes, sir, we can hear you.
Excellent, thank you. Thank you all for joining our earnings presentation for Q2 Fiscal 23 today. I'll start with a quick 15 to 20 minute presentation on Q2, and then we'll open the floor for questions. For those of you who've joined afresh, Apar, if we can move to the first slide, just a quick refresh on Delhivery. The aim of Delhivery is to build the operating system for commerce in India, which means we essentially provide the logistics infrastructure, technology, and services that enable buyers and sellers to transact with each other in the physical world. These buyers and sellers who are customers of Delhivery could be businesses transacting with businesses, businesses transacting with consumers, or consumers transacting with consumers within India or from India to the world or the world to India. In terms of a quick snapshot of Q2, Delhivery continues to be India's largest integrated logistics platform. We recorded revenues of about 1,796 crores in Q2 of financial 23, which represents a 9.3% year-on-year growth rate over Q2 in financial year 22. Adjusted EBITDA margins have improved to -7%, which is an improvement of about 547 basis points from Q1 financial 23. We delivered about 161 million packages in our express delivery network, which represents a 19% growth year-on-year from Q2 in financial 22. We remain the leading independent express player in India and have delivered close to about 1.7 billion packages since our inception. Our part truckload business continues to be one of the largest BTL businesses in India. We recorded 20% quarter-on-quarter growth from Q1 when we had seen a decline in volumes versus Q4 due to our integration with SpotOn. We've delivered close to about 2.7 million tons since our inception in financial 19. We continue to be one of the largest players from an infrastructure and reach standpoint across the country. We operate close to about 18.5 million square feet of logistics infrastructure, which includes trucking terminals, automated sortation centers and gateways, freight service stations, collection points, and delivery centers. Over 28,000 customers depend on Delhivery's network for a variety of different services. Over half our revenue today comes from customers who use 2 or more of our services, and we cover 18,454 PIN codes across the country of India based on the definition of PIN codes provided by the Indian Post. In terms of a quick snapshot on operating metrics, our PIN code reach has increased to 18,454 PIN codes at the end of Q2, as I mentioned. We continue to service 220 countries from both an imports and an export standpoint through our global partnerships with FedEx and Aramex. Over 28,000 customers, as I mentioned, use one or more of Delhivery's various services. From an infrastructure standpoint, we operate close to about 18.4 million square feet of infrastructure across the country. The key change from financial 22 and from Q1 financial 23 to Q2 is that our integration with SpotOn and consolidation of infrastructure between Delhivery and SpotOn, as we had mentioned, is underway and continues as per plan. We've seen a reduction in total number of gateways from 123 at the end of financial 22 to 96 as of Q2 fiscal 23, and a reduction in the total freight service centers that we operated as independent networks from 267 as of financial 22 to 188 as of Q2 financial 23. These are the two lines that are highlighted in red on your screen. And the team size overall has reduced from a total team size of 60,373 to close to about 56,500 people as of Q2 fiscal 23. We expect this integration and the benefits of consolidation to continue through the rest of this financial year. Moving to the next slide, some highlights since the last earnings call. Our express parcel business continues to remain robust. We remain the largest independent express logistics company in India. We saw 19% growth in volumes year on year in Q2 of this year. But more importantly, in the festive season towards the end of the quarter, we saw an 80% growth in festive season daily volumes versus the rest of the quarter. We continue to have a unique capability and a dominant position in fulfillment of heavy goods with a 30% growth in volume over the previous quarter in Q1. We also continue to regain market share in the part truckload business post our integration with SpotOn. We are today one of the largest PTL freight networks in the country. We saw 20% growth in volumes in Q2 compared to Q1. More importantly, network service levels have remained stable across all business lines and above 90% as clients measure us. The integration issues and operational issues that sprang from our integration with SpotOn in Q1 have been conclusively resolved as of Q2, and the network footprint rationalization is underway as per plan, and as you can see in the numbers that shared earlier. While our core businesses, which are Express and PTL, continue to maintain position or grow rapidly, we're also seeing momentum across our newer businesses. Our supply chain services business and our full truckload business have shown significant growth since the same quarter last year. Client acquisition momentum in the SCS business continues to be robust, with large enterprises trusting us to run their entire supply chain operations. And we continue to also see strong growth in our cross-border express and freight businesses, despite a global slowdown and a decline in air and ocean freight yields. A quick snapshot of what volumes in the express business look like. This represents 3-day average pickup volumes over the last quarter, July, August, September. As you can see, towards the end of September, we saw a seasonal spike in volumes as part of the e-commerce sales season. This spike was about 2.3x of Q2 financial 22 and 1.9x of Q2 financial 23, the average volumes that we saw prior to the peak. We expect to continue to see growth in Q3 and some growth in Q4 as well. In terms of financial performance, as you can see on the bars on the left, revenues from services have grown from 1,644 crores in Q2 fiscal 22 to 1,796 crores, which is a growth of about 9% year on year. Express and PTL continue to be the dominant revenue lines, together forming close to 79% of revenues in Q2. And our newer businesses, which have grown rapidly, continue to form 21% of our overall revenues. The bars on the top right represent the express business. We've seen a 17% growth in revenues year on year from 960 crores in Q2 of financial 22 to 1,125 crores in Q2 fiscal 23, and a 19% growth in volumes from Q2 fiscal 22 to Q2 fiscal 23. The PTL business has grown from Q1 financial 23, which is when we faced operational issues due to the integration of SpotOn. However, we've grown on the back of improved service levels from 259 crores in PTL revenues to 293 crores in Q2 fiscal 23. And we've also seen an increase in volumes from 239,000 metric tons of freight to 286,000 metric tons of freight in Q2 fiscal 23. Our newer businesses, as I mentioned, continue to do well. Supply chain services has more than doubled the number of active engagements versus September 21, which is the same time last year. We continue to win accounts across a number of industries, which include quick commerce, baby products, the auto industry, electric vehicles, agri-tools. We have leading enterprises who work with us across a number of verticals already, which include auto, consumer durables, consumer electronics, FMCG, and industrial products companies across India. Our truckload services platform has also nearly doubled from the same time last year. We continue to add new accounts across a variety of different verticals. The key ones obviously being pharmaceuticals, paints, the tire and auto industry, and consumer electronics. More importantly, we are seeing product-led growth in this business this year, as a significant portion of truck placement and supply is now transacting digitally via our supply-side applications and via our marketplace, which reduces both the cost of supply, improves pricing transparency, and improves service quality in the truckload exchange. And finally, on the cross-border side, we continue to gain customers both for our express and our freight businesses, independently and through our partnership with FedEx. We won key accounts across industries such as industrial engineering, electrical equipment, renewables, and FMCG. We've also launched a new key project which integrates our domestic PTL and FTL trucking solutions with international ocean and air freight solutions, essentially providing a complete door-to-door delivery service. This is targeted at critical sectors like pharma, auto, and engineering. We have a strong position established on intra-Asia air freight, and also our FedEx partnership continues to scale for express parcel exports. In terms of revenues, as I mentioned, newer businesses continue to contribute a meaningful portion of our revenue. They are today about 21% of total revenue. The FTL business has grown about 90% year on year from Q2 fiscal 22 to fiscal 23. Supply chain services has grown 60% from 112 crores in Q2 fiscal 22 to about 180 crores in fiscal 23. And cross-border has grown about 33% from Q2 fiscal 22 from 80 crores to about 100 crores. The decline from Q1 to Q2 in the FTL and supply chain services business is a reflection of seasonality in our underlying customers' businesses. Now, while revenues have grown, more importantly, economics have improved sharply in Q2 compared to Q1. As we discussed on our last earnings call, Q1 earnings were affected by our integration with SpotOn, where we continued to run a relatively underutilized network to allow service to recover and to settle claims with customers. Service EBITDA, however, for Q2 stands at 86 crores, and service EBITDA margins have improved from negative 0.3% in Q1 fiscal 23 to nearly 5% in Q2 fiscal 23, which is a strong reflection of the massive underlying operating leverage in the combined network between Delhivery and SpotOn. Overall, at an adjusted EBITDA level, this has improved from negative 217 crores in Q1 fiscal 23 to negative 125 crores in Q2 fiscal 23. I think the important thing for us to note, and that we're pleased to see, is that post-integration of the Delhivery and SpotOn networks, the operating leverages that existed in a pre-integrated Delhivery standalone network continue in the combined network as we've integrated successfully. The key driver of the movement in adjusted EBITDA, as I'd mentioned, is essentially the massive incremental gross margins that exist in our transportation business. Q1 fiscal 23 adjusted EBITDA stood at negative 217 crores. Of this, 46 crores that we'd mentioned in our last earnings call was a one-time integration expense related to provisions and vendor payments as part of the SpotOn integration. So excluding that, Q1 fiscal 23 adjusted EBITDA stood at negative 171 crores. The incremental revenue in transportation generated in Q2, which includes both e-commerce, express, and PTL, stands at 107 crores, and the incremental gross profit in our transportation business stands at 53 crores, which gives us an incremental gross margin across transportation of approximately 50%. And as I'd mentioned, reflects the massive operating leverage that exists in the combined Delhivery and SpotOn network. This is what has led to a total improvement in adjusted EBITDA from negative 217 crores in Q1 to negative 125 crores in Q2. And as volumes continue to come into the delivery network, from here on, we expect incremental gross margins to behave predictably and profitability to continue to improve. This is just a quick graphical representation of the same point. In Q1 fiscal 23, adjusted EBITDA had dropped to negative 12.5% owing to one-time costs and integration costs. This has improved to negative 7% as volumes continue to come into the network. We expect adjusted EBITDAs to continue to improve. As a quick bridge, if you focus on the column in the middle, which is Q2 fiscal 23, total revenue from customers increased to 1,796 crores compared to 1,746 crores in Q1 fiscal 23. More importantly, total absolute expenses reduced from 2,206 crores in Q1 to 2,158 crores in Q2. The major adjustment is simply for non-cash recurring costs, which add up to 221 crores. That includes 142 crores of depreciation and amortization expenses and 79 crores of ESOP expenses, effectively giving us an adjusted EBITDA of negative 125 crores or negative 7%. In terms of cash PAT, the picture is stronger. Cash PAT for Q1 stood at negative 10.4%. As of Q2 fiscal 23, adjusted cash PAT has improved to negative 1.7% with an adjusted cash PAT loss of 32 crores in this period. The cash PAT bridge looks exactly the same as the adjusted EBITDA bridge. Losses after tax for Q2 fiscal 23 stood at negative 254 crores compared to negative 400 crores for Q1 and negative 600 crores for the same quarter last year. The major adjustment again is for non-cash recurring costs, which are depreciation and amortization, ESOP expenses. The adjusted cash PAT therefore stands at negative 32 crores or minus 1.7%. That covers the presentation. In terms of a quick summary, this quarter has been one of consolidation for Delhivery. We continue to be, as I mentioned, the leading player, the leading independent express player in the country. We've delivered over 161 million packages in the last quarter, and we continue to maintain our strong market position. The PTL business, this was a quarter of recovery. Volumes have grown by 20% compared to Q1. Service quality and integration has improved, and integration issues are now behind us. We've gained market share, and we still are one of the largest PTL players in the country, expect to continue to gain share. Most importantly, from an economic standpoint, service EBITDA has recovered sharply in Q2 to 4.8%. Our incremental gross margins are at 50%, and the operating leverage in the combined business post-integration remains intact. With industry-leading service quality, with the size of our network and our reach, we will continue to evaluate the strategic option to use our incremental gross margin to gain share across all the industries that we operate in. And finally, our newer businesses continue to see strong demand from customers across various industries. We've seen massive year-on-year growth across truckload, supply chain services, and the cross-border businesses. We remain optimistic about the rest of the financial year and financial year 24. With that, I'll pause and hand back to the Citi team for questions. Thank you.
Thanks, Sahil. As a reminder, participants can use the raise hand feature to ask a question. We'll take the first question from Mukesh Saraf of Spark Capital. Operator, kindly unmute their line.
Yeah, good evening, and thank you for the opportunity. My first question is on the express parcel growth of 19% this quarter. Could you indicate some sense on how the industry has been? Have we maintained market share, or have we gained market share, or any change in market share there on the express parcel?
Thanks, Mukesh. We believe that we have continued to retain the market share that we had as of last year. I think our position as we look at each of our individual client accounts remains intact. Depending on which clients obviously see different levels of growth over the year, our consolidated market share position may change accordingly. We obviously have larger share with some customers and less share of wallet with some customers. But overall, our competitive position on the express industry remains intact. We continue to have the same cost and technology advantages that we had as of last year and continue to exercise that to defend market share.
All right. Would you be able to comment on, say, large e-commerce platforms such as Meesho, which have on media been kind of commenting that their growth has been significant, much higher, maybe than say 40-50% is kind of a number. So, any wallet share shifts in such large accounts?
None that we have seen. We continue to maintain the sort of market share with each of our individual accounts. And overall, if you look at it, as I mentioned, we saw massive growth in volumes with seasonality.
Right. Thanks for that. And secondly, on the PTL business, we see on an average, we have done probably about 3,200 tons a day. Last year, same quarter, we were about 4,500 tons, and in the fourth quarter, we're upwards of 5,000 tons. Could you give some sense on at what rate we exited second quarter, and probably some indication of how October, November has been?
So we're currently at a rate which is close to about 3,400 to 3,600 metric tons of freight a day. I should add some context over here. In the PTL business, our first port of call was really stabilizing service issues post the integration on Q1. I think we've successfully navigated that period in Q2, and service levels, in fact, are better than they were in a pre-integration world, not just in terms of network speed and reach, but also in terms of quality metrics, which include shortage deliveries, damage deliveries, and so on. So this has actually been a pretty good quarter from a service level standpoint. Also, the other sort of exercise that we undertook post-integration was to take a look at all of the individual client accounts that we had, both as Delhivery and as Spot On, to evaluate accounts which were unprofitable for Delhivery and Spot On, and either renegotiate pricing or eventually stop services. and also to get out of certain accounts where we have to provide highly bespoke services, where it made more sense for us to focus on sort of a standard SPTL product.
Sure. And just last one, if I may squeeze, we did get some sense, from the industry participants that some of the large e-commerce platforms are looking to split the services across first mile, mid mile, and last mile between different vendors. While Delhivery does provide end-to-end logistics, do you think this in any ways is happening, and will this impact Delhivery's positioning in the market?
Not at all, because when we establish the fact that we are the lowest cost operator in the space, we are not just the lowest cost when bundled, we are also the lowest cost at each individual leg of the transaction. Our first mile cost is the lowest, our mid mile cost is the lowest, and our last mile cost is the lowest. So this is actually a structural advantage. And I think it makes more sense to outsource it. So delivery, essentially what I'm saying is it's impossible to unbundle delivery.
Right. Got that. Thanks a lot, Sahil. I'll get back in the queue.
Thank you.
The next question is from Gaurav from Morgan Stanley. Please go ahead.
Hi, thank you for taking my question. So first question again is on the express parcel business. How should we think about recovery from here? Going by the commentary that you made on the festive season, it appears that we are likely to be under 20% growth for the next 2 quarters. So how should we think about transition back from 20% number to like 30%, like we have been doing sustainably for last several years? How should one think about that?
See, I think in the express business, it's a pretty simple answer. We monitor our share of wallet with every single account that we work with. We also manage our overall client portfolio to make sure we're not unnecessarily concentrated with any single account. We will maintain our share of wallet with every single account that we have. And depending on the underlying growth that each of these accounts will see in the market, our consolidated market share will change as a consequence of that. The other important thing to note is that ultimately we are the highest quality network. We are the largest network from a reach standpoint. And we also have the lowest cost structure. Our incremental gross margins are shared with you. And so our ability to use our gross margins to protect our share if we have to is also in some senses unlimited. So that's sort of the way I would think about it. We will essentially maintain our leadership in this space.
Got it. Secondly,
if I can add, we will periodically go back and look at what we believe is the market size and scale and what our share is with each player. And obviously we triangulate it through various sources. It's not something that is given to us, or we don't have a Nielsen in our industry as such. And as Sahil said, I think we will make adjustments. And if you feel like if there's any count where we feel like our share position has changed, we will actually do what we need to do to defend our share under any circumstance.
That's very helpful. You had given a number a couple of quarters back. I think that your market share in the overall express parcel business is around 21 to 22% or even higher than that. Where do we stand as of now in your broad estimate?
Not significantly changed at all.
Got it. Last question on the 50% incremental gross margin. Should we think about going forward that kind of a ratio holding up, or in the sense that correlation holding up, or is it also the fact that we created a lot of capacity this year and that is why the incremental gross margin is very high? So how should one think about the, more like a sustainable incremental gross margin in this business of transportation? Thank you.
That's actually a very good question, Gaurav. In fact, today, as I look at the network, our incremental gross margins could have been higher, which means we continue to carry a little bit of capacity that is underutilized in different segments. Obviously, when you look at capacity, it's a complicated sort of decision because there are different points of capacity. As an example, the automated sort stations continue to be quite heavily capacity utilized. The hubs and the line haul network are still running slightly underutilized, and the last mile network can probably absorb another 30% volumes overall. So the capacity answer is sort of split across different legs for delivery. So one, I think our overall incremental gross margins could increase from here. The second is this is based on historical precedent. Obviously, as we start getting to capacity utilizations of close to 85 to 90% and have to reinvest, we see incremental gross margins at that point coming down to maybe about 45% or so. But there's basically massive underlying operating leverage in our business.
That's very helpful. Thank you so much.
The next question is from Pulkit Patni. Please go ahead.
Yeah, thank you for taking my question. My first question is, when I look at the slide where you talk about your key operating metrics, and between Q1 and Q2, we've seen some reduction in capacity. Now, while this is clearly, for better integration of spot on, just want to understand, does it in any way also indicate our thoughts about growth? Because, for a company which is in a high growth sector, to actually cut capacity at this stage, how should one look at this in terms of growth for us, say over the next few quarters, going forward? That would be my question number one.
Sure. You should not view this in any way as compromising our estimates of growth going forward. This is the number of freight service centers that we run. If you look at the overall infrastructure that we run as of the end of financial 22, we had 18.15 million square feet of infrastructure that has risen to 18.46 as of Q2. Our network team continuously reevaluates the structure of the underlying network and decides what is best for us to consolidate. Let me give you an example, Pulkit. As an example, even today, because of Delhivery and Spot On having independent hubs in Pune, we continue to run 2 hubs in Pune. Over the next 18 months, those 2 hubs will be consolidated into a single hub. Now, while that may not reduce our overall infrastructure footprint, because we may continue to operate the same space, what it does is bring massive efficiencies to the operation in Pune, because essentially we can eliminate several of the costs that we have to duplicate between the 2 facilities, and also the inter-hub connections that we have to run at this point because we run 2 facilities. So essentially, all of this consolidation is to drive better efficiency. As our volumes go up, we make automated decisions on how to expand the network, and nothing will change on that front.
Okay, that's useful. My second question is on competition. I think somebody did touch upon this. Whether it is Flipkart or Amazon who are talking about, doing logistics for third party. Misho in an interview mentioned that they don't look at this as a cost center, as a profit center. I mean, just wanted to get your thoughts that in the last, say, 6 odd months, do you think that the competition matrix have changed for us in any way, or you think this was something which was anyways in works and really doesn't change much? Because I think it has implications in terms of our ASPs, and that's why I wanted to get a better understanding of this aspect.
Certainly, I think it's a very topical question. Let me begin with competition. I think this state of competition that you refer to is a state of competition that has existed for several years. It's been pretty much the same players arguing for pretty much the same strategies for nearly half a decade now. And so in terms of either competitive intensity or in terms of sort of various competitive players' strategies, nothing has fundamentally changed in the market. The express market is a competitive market, but to be clear, it is not determined purely by one factor, which is price. It is determined by the reach of the network. It is determined by the quality of delivery and the speed of delivery. There are several auxiliary service metrics that customers use to decide. And finally, with all of these being a hygiene factor, there's the question of price. As we'd mentioned, Delhivery has a strategic competitive advantage, which is that our cost structure is significantly lower than either our listed or our unlisted peers, and certainly lower than captive arms of e-commerce companies. More importantly, we're actually designed to service third parties, as opposed to being fundamentally designed to serve first parties and then trying to externalize. So I think nothing weakens our competitive advantages in any way. Different players obviously will try different strategies over the next couple of years. It's a large market. But from our standpoint, we have the leading cost structure. We have a massive balance sheet. We have a fully invested in network and an experienced team. So in that regard, for us, competitive intensity is something that we watch, but not something that gives us any sleepless nights.
Fair point. Maybe I'll take the liberty of asking one more. Can you give us a sense of the PTL freight tonnage? When should we expect us to get back above the 400,000 quarterly run rate?
Certainly, I think on PTL, as I'd mentioned, the first and most important thing for us to do was to put the operational issues of the spot-on integration conclusively behind us. And as I'd mentioned, I think we're quite happy with where we are now. Overall, if I look at service quality across the network, which includes both service speed as well as quality metrics, we are trending at levels that are ahead of where we were even pre-integration in Q3 and Q4 of last year. That really was step number one. Step number 2 for us was then to take a long, hard look at all of the different customers that both Delhivery and Spot-on serviced. While it would have been easy for us to simply show volume growth, I think we went ahead and looked at each of the accounts individually, looked at accounts which made sense for us from a gross margin and an EBITDA standpoint, and also looked at the kinds of loads that we were transacting and whether they required any special services or any special handling that doesn't necessarily fit well into the delivery scheme of things. And I think if you think about it, we took a leaf out of the page of Old Dominion and studied it quite carefully, and that's going to be our approach going forward. So internally, a target for us right now is not immediately to figure out how to get to a specific volume number, but to get the unit economics to where we need them to be. As I'd mentioned, we've seen a sharp recovery to 4.8% on service EBITDA. We'll continue to grow that over the next couple of quarters. Be quite selective about the clients that we onboard and make sure we continue to operate with the same service quality that we're at right now.
Fair point. Thank you so much, Sahil, for those answers.
Thank you. We'll take the next question from Aditya Mongia.
Thank you for the opportunity. The first question that I had was more linked to the part truckload business. Now, on a Q-on-Q basis, it seems as if there has been some reduction on a per ton revenue number or the yield number. Just wanted to get a sense of whether we today are starting to offer more discounts that will come, which will become lesser over time, or is there something else which is maybe more seasonal associated with this Q&Q movement?
No, so we are not offering any additional discounts. The optical change in the yield that you can see per kg is due to one, there is an Ind AS adjustment that we have made. The second is that for Spot-on earlier, a certain percentage of the revenue was being recognized on pickup volumes. Delivery, however, operates on a conservative approach where we recognize based on closures. And that has also led to a change in the overall yields. I think as you see Q3 and beyond, you will see yields normalize to where they were in the Q1 timeframe, which is somewhere between 10 and 11 rupees a kilogram.
Sure, that clarifies. And the second question that I had was on the express parcel segment. Now, as both of us are understanding, there is a moderation in the industry growth, maybe from high 20s to high teens at this point of time. I wanted to get a sense of how much of this would, in your opinion, be more cyclical in nature, and how much of it, in your opinion, could be actually structural from here on? I'm just trying to get a sense of when things normalize. Will they completely go back to where they were, or will there be a middle ground achieved?
See, I think when you look at the underlying market for e-commerce in India over the medium or long arc of time, the underlying growth in e-commerce volumes is undeniable. I think the reason why growth in this year perhaps looks moderated when viewed externally is really because a lot of growth was pulled forward during the COVID period. And this is sort of growth that otherwise would naturally have manifested later. I think the end point for e-commerce remains pretty much exactly the same. It is a growing convenience category. We continue to see penetration in tier 2, tier 3, tier 4 cities and beyond. As an example, our heavy goods business, which has seen a 30% growth from Q1 to Q2, represents sort of a pretty interesting and widening array of categories that are available online. Now, whether a specific quarter or a specific year in e-commerce will be distorted, like COVID as an example, where e-commerce companies saw 40-50% growth rates, or a year like this year where Shopee has exited the market and growth therefore looks somewhat moderated or muted. I think overall, our view is that the structural shift to e-commerce will remain intact. More importantly, from our standpoint, it is somewhat irrelevant because we will continue to maintain share with all of the accounts that we have. And as I mentioned, our structural cost advantages are not dependent merely on scale. They're not dependent on delivery growing at 30% a year. The underlying cost advantages that we have make us the most efficient player at 161 million packages a quarter. That will continue whether we are doing 161 million packages, 200 million packages, or 140 million packages quarter going forward. And so from our standpoint, irrespective of how the growth curve pans out in the short term, in the long term, our competitive advantages remain intact.
Just one last question from my side.
Sorry, Aditya, if I can just add on top of that,
Sure,
Sandeep.
sure.
that if you go back and look at e-commerce over the last 11, 12 years, you will find that this story has played out before, because you've had periods where the long-term trajectory continues to hold, but you've had periods where when discounting, for the first time, when just aggressive discounting became sort of less popular, you had a couple of years of soft, and then it came back fully when it became truly a convenience category. So I think you'll have those cycles. In today's funding environment, you'll have some cycles on individual players under feeling some pressure and things like that. But as Sahil said, the penetration of as a channel, the penetration is still so low of e-commerce. There's no reason to believe that the long-term growth in e-commerce should be any different.
Understood. Just one last question from my side, and thanks, Sandeep, for the color. The question is more on this 50% gross margin thesis that one is thinking through. If I kind of extrapolate this argument from your current revenue base and go into more towards, let's say, 3Q, 4Q, it seems as if that can help you at an adjusted EBITDA margin level reach high single-digit levels. Is there something that you believe can happen, let's say by the end of the fourth quarter, that the company starts reporting closer to 10%, at least for that kind of 23, 24, 2500 kind of top line, a decent marked improvement in adjusted EBITDA margin?
Certainly, actually, Apar, if you are on the presentation still, can I ask you to please go to the adjusted EBITDA slide? Not this one, the bar chart, please.
The next one.
Bar chart with,
Yeah, this one.
That's right. So this is just a quick snapshot of how adjusted EBITDA was trending prior to this, and services EBITDA obviously before this. I think so. One is we clearly know how to get to where we were in Q3 and Q4, as you'd mentioned, because there's sort of a sense of predictability because the incremental gross margin is at 50%. As volumes come in both in the express and the PTL business, we expect overall that the company's adjusted EBITDA will continue to improve. So far in Q3, I think we're quite satisfied with where we are, and we expect this to continue. But when will we get to exactly 10% adjusted EBITDAs, I think is a function of the choices we make in terms of the customers we onboard in PTL and how soon we bring PTL volumes back. But the important thing to note, I think, is that it's a relatively predictable business from here on.
Yeah, got that. I have more questions. I'll come back into the queue. Thank you.
We'll take the next question from Alok Deshpande. Alok, you can proceed with your question.
Yeah.
Please go ahead, Alok. I think you muted yourself.
Yeah. Okay. So I just wanted to refer to a couple of statements that you had mentioned in your Q2 business update, which had come out a few days back. So one was you mentioned that while the festive season sales surge in shipment volume will spill over to Q3, we anticipate moderate growth in shipment volumes through the rest of financial years. Now, this moderate growth that we are talking about, is it more because of a much higher base in the H2 of last year, or is it a general sequential growth which you think will be quite moderate in nature? So I was just
certainly, I think, Alok, the big change, that's an important question actually, and we should have called it out. The big change, obviously, when you look at H2 of last year, is that H2 volumes were somewhat distorted by the presence of Shopee in the market. And so overall volumes, not just for delivery, but overall for the e-commerce industry, were significantly higher. And with Shopee disappearing, while some of that volume has obviously been retained and has gotten spread out across other e-commerce companies, some of that volume has basically simply disappeared. And so that's really the reason. I think if you look at our growth in volumes overall, we've seen about a 6-7% growth in Q2 over Q1. We would expect a similar range, or maybe slightly higher or slightly lower than that, in Q3 over Q2. And And overall for the year, therefore, somewhere between sort of an 18 to 30% kind of growth rate overall.
Okay, this is so when you say 18 to 20%, that is including Shopee last year, right? Or
Yes.
you're saying like to like?
Including Shopee last year overall.
Okay, understood. And my second question was regarding PTL. So you mentioned that you're currently doing about 3,500 odd sort of tons a day. As this number sort of starts creeping up towards to slightly higher levels in Q4 or so, do you think that at a overall level, at a group level, the EBITDA the adjusted EBITDA can go in green based on this?
Yes, of course. Yeah, absolutely. See, it's an extremely important component of our business. When we say that we run an integrated network, that means our mid-mile and our line haul are sort of, for them, PTL and Express are indistinguishable. And therefore, growth in volumes in either of the two obviously improves unit economics in both. It improves utilization of the hubs, it improves utilization of the vehicles that we're transacting. More importantly, it allows us to make one of the big strategic shifts that only integrated players can really pull off, which is a shift away from more inefficient truck sizes to far more efficient truck sizes that we use across our network. And so, in fact, the faster PTL volumes recover, the better it is obviously for our mid-mile utilization.
Sure. Thanks, Sahil, for that. That is very helpful. Thanks a lot.
We'll take the next question from Sachin Dikshit. Sachin, go ahead.
Hey, hi. Congratulations on results. I had a quick question with regards to the steady state service EBITDA margins, right? So while I do understand that delivery is decently dominant in terms of the express parcel business and as well as the PTL business being growing since the integration, but it remains a cost line item for most of your clients, right? And who might not be happy with giving you insane amount of margins. So where do you think your service EBITDA margins stabilize and how's the journey to it?
So Sachin, actually, the point that you make is precisely the point that we believe is a strategic advantage, which is that this is a cost for our customers. Our objective is not just to state that we're building the highest quality transportation player in India. We're also building the lowest cost transportation player in India. And in the express parcel industry, I think if you were to do a benchmarking, you would find that we have the lowest cost structure out of our competitors. And so the fact that our customers are extremely price sensitive is in fact a competitive advantage for delivery. And as I'd mentioned with our incremental gross margins, our ability to use our gross margins to drive up market share in the underlying industries that we're in is massive. We have done this in the express parcel space. We evaluate every one of our customer contracts continuously and make sure efficiencies are passed on to them. And essentially we get rewarded for that in the form of excess market share. So the risk that you're pointing out, we actually think of as the fundamental opportunity at delivery, because when you think about it, direct costs of logistics in India have to reduce. And only large integrated players will have the ability to reduce it, which is sort of what the core of our business is all about. In terms of service EBITDA margins, as I'd mentioned, if you were to look at the overall incremental margins that we're generating, it is possible to actually model out what margins for delivery will look like going forward. In our experience so far, the service EBITDA margins for our transportation businesses can reach levels of close to about 17 to 20% based on the utilization of the network without service degradation. Obviously, as we continue to introduce more trailers, as we continue to introduce more automation across our hubs, there is the opportunity to fundamentally disrupt that cost structure further as well.
Sure, thank you. And can you also give some understanding on how the supply chain services business is going on and how are you acquiring customers there?
Sure. In the supply chain services business, essentially, it is a end-to-end fulfillment services business that we run, where, as an example, one of India's large consumer durables players came to us and said, look, we want to focus on manufacturing and running sort of our retail footprint, whereas we want you to run the entire supply chain. So we handle warehousing, we handle inventory management, we handle primary distribution, secondary distribution, across the country for them. So the typical engagement will include warehousing, full truckload freight, part truckload freight, and express delivery as well. the margins that we see in that business on all the transportation businesses are equal to or higher than the margins that we see on the transportation businesses standalone. And then on warehousing, we take a strategic call account by account as to what kind of margins or pricing we want to offer to customers. Typically, these are long-term contracts to run either entire regions or the entire supply chain for the customers that we have. The reason customers choose us is very simple. One is the underlying philosophy of our business model is it allows our customers to variabilize their supply chain costs, and obviously at the same time have access to the highest quality transportation partner in the country, and to centralize procurement of logistics with a single partner. So you don't need to run multiple 40, 50 different partners helping you with either trucking or with express delivery or with warehousing. So it brings predictability, it brings transparency, it brings speed. Our focus obviously is on sectors like, for instance, where obviously supply chain complexity is high. So obviously e-commerce is one of them, consumer durables, consumer electronics, auto and auto spare parts, FMCG, pharma, some parts of industrial goods. These are sort of the industries that we remain highly focused on.
If I may add, what has happened over the last 6 months is that the number of industries that we serve has widened. The number of use cases that we've proven out that this model works and is actually have increased. And so we now actually have a much larger scope that we can actually go after in the market, and more success examples that we can share with customers. The other thing that you should also note is that the supply chain services revenue, when we report it, it includes a decent chunk of part truckload and full truckload, not just warehousing. We just don't double count it. It is actually reported within supply chain services. So underlying part truckload volume that we probably handle is actually significantly higher, as well as the underlying full truckload volume.
Great. That sounds perfect. Just one final question on this ONDC that the government is pushing. What are Delhivery's plans to participate or not participate? How do you think of it? Just last question.
We are discussing integration with ONDC, and I think we obviously will be integrated and will be a logistics partner of choice for all of the sellers on the ONDC platform. But as of now, I think the platform itself is still maturing. And as it gains traction, I think some of our plans with regards to ONDC will become a little clearer. From our standpoint, though, our services are easily accessible. We'll integrate with ONDC, and if it scales, we're happy to be sort of big partners.
Great. Thanks so much.
Kapil, why don't you just add?
Yeah, so we have already submitted our application to ONDC, and as Sahil mentioned, as the platform picks up, we'll start seeing the app on their platform, and you'll see the app on the platform very soon over there.
The testing is done.
Yeah.
Got it. Thank you.
The next question is from Abhishek Ghosh.
Yeah, hi. Am I audible?
Yes, Abhishek.
Yes, you are.
Yeah, hi. Thanks for the opportunity. Sahil, just since you're on the supply chain business thing, just one observation. Q on Q, we have seen a decline in revenues by almost about 20-25%. Any change in accounting? Because we usually thought this is a seasonally strong quarter. How should we look at it? Any thoughts there?
Yeah, sure. It's basically just underlying seasonality for a couple of our customers for whom Q2 is not historically sort of a strong quarter. As an example, in consumer durables, one of our customers has significant seasonality in Q2, and that's what has affected overall revenues for the quarter. But that will rebound in Q3 and Q4 as ship outs increase. No change in accounting standards. It's an underlying sort of reflection of the customer mix that we have.
Okay. But is the dependence on one particular client a little higher? I'm saying over a period, should we see this thing going up because the market opportunity is quite high and your market shares are pretty low? So how should one look at it?
Obviously, that's actually the right observation. We do expect over time the impact of this seasonality in any single customer to reduce. I think the other thing in our supply chain services business is that revenue, while accounts begin, the full sort of impact of revenue growth takes typically anywhere from about 2 to 6 months to reflect, because that's sort of the period that we take to stabilize operations, to grow operations across various different warehouses, because typically these customers will either be shifting from in-house operations or from a different third-party partner to delivery. So it takes a little bit of time for these accounts to reach their full potential. Even the setup time for us could be anywhere from sort of 30 to 90 days for different customers. So I think the growth that we've seen in customer name accounts in Q1 and Q2, we'll start seeing the revenue impact of that in Q3, Q4 and beyond.
Okay, that's helpful. Sahil, the other thing is, on the express parcel business, while there's a just about a percent or so increase in realization in the current quarter, how should one read this? Are we towards the end of the cost benefits being passed on, or was there a product mix impact this quarter? Any thoughts on our realization per shipment as far as the express parcel business is concerned?
Yeah, sure. See, realization overall is a function of basically 2 or 3 different things. One is it's a function of the customer mix. The second is it's a function of the distances that we are shipping. The third is it's a function of the COD versus prepaid ratio and sort of the extent of returns that the network is handling and the speed choices that various customers make. There's no underlying change in our pricing philosophy in Q2 versus Q1. That said, we evaluate every customer account differently. We have target gross margins and target EBITDA margins for every account that we operate. And as we continue to gain efficiency, we proactively pass those benefits on to our customers. One of our stated strategies is to commoditize the space that we're in. We believe that every customer should have access to low-cost, high-quality logistics. That's the foundational idea of delivery, and we will continue to sort of exercise that judgment with our customers. In terms of the question about whether we're close to the end of the cost curve, I'd have to say the answer to that is no. Because as I'd mentioned, incremental gross margins right now are at 50%. Our belief is that incremental gross margins actually could be higher as utilization of the network continues to improve. So we're not necessarily at the end of that cost curve. We still have underutilized capacity at the last mile, for example, and in certain sections of our mid-mile and hub operations. As volumes scale up, that will get utilized. The other benefit, of course, when running an integrated network is that because our mid-mile and our hub operations do not distinguish between PTL, freight, and express, growth in either of those businesses contributes to an improvement in economics in the other. So as PTL volumes go up, express becomes more efficient. As express volumes go up, PTL becomes more efficient because we're able to run more docks across our hubs, we're able to run larger trucks, we're able to run greater frequencies. And we expect that to continue. So, over the next couple of quarters, I think we will introduce more tractor trailers across all of the critical routes. We will increase utilization of the trucks. And as that happens, overall cost per shipment will continue to come down. And at an account to account level, we will make the call on how much we want to pass on to our customers.
Okay. Sahil, just one more question. If you look at the PTL business as it's already visible, you're almost about 20-25% down, or maybe a little higher on number of shipments from the last peak that you had done. So there has been some business loss because of the integration and other things. So how difficult it is now to get back those customers, and because somebody would have got that share in the meanwhile, and so are you having to discount it? Well, you mentioned you're not discounting it. So what are the challenges? Is there a change in the medium-term growth rates for this business given the whole integration issue? Just some thoughts there, because once a customer goes away, to get him back, you have to offer him something extra because, it's a customer experience. So just from that perspective, your thoughts.
Absolutely. I think, the first thing is we looked at all of the accounts that we currently are active with. And fortunately, accounts representing nearly 90% of our revenue pre-integration are active with us and are working with us. Some of the accounts that are not active with us include retail partners where we felt that the loads that were being tendered into our network were not appropriate for our network. And there are certain customers, like I'd mentioned, who continue to operate other parts of their requirements with us, but where we felt that their PTL requirements were not ones that fit the delivery network. And we've consciously decided not to continue with some of those accounts. I think the important thing that customers look for is service quality, which includes not just network speed and reach, but also quality in terms of shortages and damages and potential claims. As I mentioned, what we're particularly happy about is the fact that service quality as of now is better than we were at pre-integration levels, which means the integration not only has been conclusively completed, but in fact, some of the service gains that we expected to see have played out as of now. Obviously, we continue to remain quite watchful because it's only been a couple of months since the integration has stabilized. But that's the leading indicator of share gain. while customers are price sensitive in this market, I think it is important to recognize that freight as a percentage of value of goods shipped is not very large. And so customers are sensitive to quality of service. The second thing is that different logistics companies at different points in time are affected by operational constraints. I wish I could sit here and tell you that there are no further operational constraints which will ever affect delivery going forward. But as an example, if you happen to build your hub in a part of Bhiwandi, which goes underwater when it rains in Bombay, you are bound to have service issues. And at that point in time, customers will select an alternative. Customers are also understanding of the fact that they have to shift loads across different logistics partners when various networks have issues in specific locations. That's why they run redundant partners. And that's why it's not exactly a winner-take-all market, but it is possible for somebody to build dominant scale. And that's really what we're going after. So long answer to your question, no, we don't have to offer discounts to regain customers. Our service quality is what gets us those customers along with our reach. We're becoming more selective about the kinds of customers we want to admit to make sure we can maintain that service quality and the margins that we want to generate. And overall, I think we are going to see recovery in this business over the next couple of quarters.
Great, Sahil. Thank you so much and wish you all the best. Thank you so much.
Thank you.
The next question is from Abhijit Mitra. Please go ahead.
Yeah, hi, am I audible?
Yes, Abhijit, if you can speak up a bit, please. Thanks.
Yeah, sure. Thanks. I have three questions actually. Again, from the slide 5. The number of customers, it has dropped by almost 1,000, 1,100 on a quarterly basis. So how do you sort of what are your thoughts and how do you see these numbers as you move ahead? So Q1, probably the number of customers was closer to 29,300, now it's 28,100. So how do you feel these numbers will move as we move ahead? That was question number 1. Question number 2 is again on the supply chain side. The drop in revenues is something which we can understand. But again, on a quarterly basis, if we look at the revenue per square feet which you have reported, between Q1 and Q2 of this fiscal, divided the revenues, the square footage under management is down by almost 2 million square feet. Now, why should the square footage under management in a supply chain business be down on a quarterly basis? That was the second question. And third is, I think prior to the IPO, there was a thought process that the growth in the parcel business is more structural. But what we are seeing now is that the penetration as well as the growth in US is also coming down, and our business and our market is also sort of showing the similar sort of slowdown. So is this connected? Do you feel would you like to reconsider that was indeed a COVID bump and we're coming out of it, and globally we're seeing a sort of slowdown happen? So these are the 3 issues and topics you can shed more light on. Thanks.
Certainly. Thanks, Abhijit. Let me sort of answer these very quickly. One is in terms of number of customers, as I mentioned in the PTL business specifically, we have become more selective about the various kinds of shippers we allow to move goods through us. I think one of the things that we evaluated as part of the integration was how many different customers were tendering loads that weren't necessarily transit worthy, or which didn't necessarily fit the Delivery Express PTL product from either a sort of handling standpoint, operational standpoint, or from a margin standpoint. And so it's a sort of exercise that we undertake on a regular basis. As a standalone company, Delivery would do this anyway every quarter. I think the first time we did it, once we had integrated Delivery and Spot On, post the integration was in Q1, and therefore there were accounts that we decided proactively that we could not continue. This is a quarterly exercise that will continue for the combined business. So not very worried about this at this point. As I'd mentioned, the customers who are active with us represented over 90% of the revenue that we made in the PTL business as Delivery and Spot On separately pre-integration. In terms of revenue per square foot in supply chain services, this is also driven by the fact that if ship outs, for instance, happen to be lower in a specific quarter, while the square foot area continues to be active, since we bill only on ship outs, whenever there's a quarter where ship outs happen to be lower, since we aren't booking any revenue, the revenue per square foot in that quarter will appear to be slightly lower. So I think this is the same seasonality impact that you're seeing. We have maintained the same amount of overall warehousing space. Also, on top of that, there are new starts that are built in over here, where it takes a little bit of time for the revenue to come in. So as an example, when we're starting a new warehouse for a customer, typically inventory will start arriving and will take anywhere from sort of 15 days to 60 days to arrive, whereas billing on outbound will begin with a little bit of a lag or a delay. So in that sense, this isn't something that I think is particularly alarming. And especially if you sort of look at it from FY20 all the way to Q2 FY23, the trend is sort of pretty secular. Your third question was around e-commerce growth structurally. I think it's a very good question. There are some differences though in dynamics between the US and India. In the US, you're fundamentally talking about, first of all, a significantly more penetrated market from an e-commerce standpoint. I think when you look at India overall, as I'd mentioned, over the medium or long arc of time, it's hard to argue that e-commerce will not become a significant portion of consumption. New categories will come in. We do continue to see, by the way, growth in tier 2, tier 3, tier 4 cities and beyond. We also see increasing frequency in the metros. Like I mentioned, I think there certainly was a bump during the COVID period. There's absolutely no doubt. And if you look at the end state today, in the absence of COVID, perhaps the growth would have looked more uniform over fiscal 2021-22, instead of which it sort of got bunched up in 21-22 and therefore looks a little lower in this financial year. But I don't fundamentally believe that there is a structural alteration in people's desire to purchase online, or the e-commerce company's ability to sort of create new categories and bring greater assortment to people. One of the easy ways to look at it is to see sort of the expansion to some extent of some of the direct-to-consumer brands and the sort of speed at which these D2C companies have been able to grow. So I think overall, while this year may look bumpy, when looked at over a medium-term period over the last 3 years, I think growth in e-commerce has been solid. We don't see any structural reasons for that to not continue. And the last piece that I would point out is why we are a little more sort of insulated from small periods of low growth in e-commerce is, as I mentioned, because of our cost structure. Our competitors struggle with periods of low growth because typically in those periods, they do not have the ability to reduce pricing if they want to continue to grow. Low growth periods are good for us because, as I mentioned, even at 161 million shipments, we have a profitable express business and high incremental gross margins. We have the ability to continue to improve our cost structure. We have the ability to continue to pass those benefits on to customers and gain more market share at that point in time. So in that sense, we're a little more insulated from any short-term events that happen in e-commerce than anyone else. But again, as I mentioned, structurally, I don't think there is any reason to believe that e-commerce is sort of, not going to grow quickly in India going forward as well.
Thanks. That's all from my side. Wish you all the best.
Thank you, Abhijit.
Thanks, Sahil. We have reached the top of the hour, but we have received a few questions on the chat window. If you can take a couple of them pretty quickly before closing this call. The first one is, what is being adjusted while arriving at adjusted EBITDA versus EBITDA?
Apar, if you can just bring up that slide again, please. Yeah. So as you can see in the middle column in Q2 fiscal 23, total expenses were at 2,158 crores. This included 221 crores of non-cash recurring costs, which includes depreciation and amortization and ESOP expenses. These are the two costs that are excluded when calculating adjusted EBITDA, or the ones that have major impact. There are obviously minor adjustments, which are for finance cost on borrowings and some adjustments due to Ind AS. Rishi, should I just read out the rest of the questions and answer them?
Sure. This just next one is on the ESOP expense roadmap for the next 5 years. If you can share some color around that.
Sure. Again, Apar, I think we have a backup slide on this. And Amit, our CFO, is on the call. Amit, would you like to answer this, please?
Sure, Sahil. Can you go back to the previous slide, Apar? So we have a total of about 43 million ungranted stock options. which will be granted and which will be costed in our P&L over next 5 to 6 years. We also have unvested but granted 30.236 million, 30.2 million stock options. Now, the stock option accounting is done based on, on a model where the price of a share at the time of grant is taken. And for these 30.2 million shares, we'll just show you the schedule for the cost that is expected over next 4 or 5 years. And for the remaining 43.45 million shares, the costing will be based on the prevailing share price at the time of the grant. The important thing to note here is that a significant majority of these 43.45 million shares, nearly 26.3 million shares, will vest only if company achieves a stock price of 800 rupees a share, 1000 rupees a share, and 1200 rupees a share. So that's an important part that you should note. Move to the next slide, Apar. So the costing which is expected for the options that have already been granted based on time-based performance is 469 crores over next 5 years, including the current year. And for the performance-based stock options, it is 97 crores over the next 5 years. So a total of about 566 crore is expected based on the grants that have happened so far.
Thank you, Amit. The next question that I can see says, what is the timeline for Delhivery to become EBITDA positive? As I'd mentioned, the service EBITDA has seen a strong rebound from negative 0.3% to 4.8%, and adjusted EBITDA has improved from negative 12.5% to 7%. I think as our incremental margins, as I'd mentioned, are close to about 50%. Even if you don't assume an improvement, I think it's quite easy to model out what incremental revenues will lead to target adjusted EBITDA levels. And therefore, sort of based on volume recovery, my sense is that it's quite easy to model out over the next couple of quarters when we will turn EBITDA positive. To some extent, obviously, it depends on how quickly we decide to increase the tap on the LTL side. Which is linked to the next question, which is what is the economic benefit expected from the Spot-On acquisition, and in what time frame is the full benefit from Spot-On expected to be realized? I think the economic benefit from the Spot-On acquisition for us was clear, which is we are ultimately building an integrated hub and mid-mile operation, which is shared across our express and our part truckload freight business. Spot-On was one of the leading players, one of the leading independent players in the PTL freight business. They were larger than Delhivery, so we were growing faster. I think bringing these two networks together has given us operational heft, has given us scale. The integration issues of Q1 notwithstanding. And more importantly, as I look at our service levels today, and I look at the size of our network today, I think it provides a better service to all of the customers that Delhivery and Spot-On had standalone. More importantly, as I mentioned, because we share our hub and mid-mile operations across these two businesses, which is a complicated thing to build, but I think we're at a stage where we have built it out. Any increase in volumes in either of these businesses ultimately is accretive to both of them. So as volumes in the express business increase, we see cost advantages in the PTL business and also actually, frankly, better speeds. And as we see volumes increase in the PTL business, we see cost advantages in our express business and speed improving in our express business. It also allows us to deploy a larger fleet of tractor trailer operations across the entire country, which brings down our line haul cost, improves overall speed of the network, allows us to do more dynamic routing, and therefore improve customer experience. The question on time frame, I think, as I'd mentioned, we had intended to begin rationalizing the consolidated footprint of Delhivery and Spot-On by Q2. That has already begun, as is reflected in the reduction in overall freight service centers and reduction in gateways that happened in Q1. I think that process will continue over the next couple of quarters. Our intention was to discover the benefits of synergy value between Delhivery and Spot-On going into the next financial year. And so far, I think we're on target for that. The next question is from Anuja, which is, could we comment on plans to use more EV fleets or any other significant ESG initiatives that could be financially material? We already do use electric vehicles, CNG vehicles, and LNG vehicles across our network. In the first and last mile operations, it's actually been reasonably prevalent in different cities for several years now. These are cargo vehicles that we use for pickup and drop-off operations. We have also begun trials of LNG trucks and EVs in our mid-mile operations, which are our long-haul trucks. Our belief is that in the long run, the benefits of electric vehicles will accrue only by using these for mid-mile operations as opposed to sort of electric bikes. And so that's where our focus has been. Obviously, this de-risks us from increases in fuel costs. And so as these experiments and trials mature, I think we will introduce more and more EVs. So as an example, we're working with Volvo, which is one of our trucking partners, to experiment with electric vehicles in our mid-mile. From an ESG standpoint, the other area obviously is we continue to introduce solar power across all of our major gateways. That's sort of the other big ESG initiative that we're running internally. The next question, I believe I've already answered, which is context around growth in October. Growth in October relative to Q2. So volumes are, first of all, just to be clear, the volumes that delivery reports in any quarter are based on shipments delivered, not shipments picked up. And so we do expect that October will be a high month as well, because significant number of shipments that were picked up towards the last week of September will be recognized as delivered in October. I think overall volumes in Q3 remain in line with our expectations overall. You know, the festive peak of September was a big high point, and then volumes sort of return to normal, start growing again towards the end of the year. We don't see any fundamental change in industry structure overall. How should we think about CapEx and lease additions going forward, considering the revised growth expectations? I think, as I mentioned, right now, we continue to consolidate infrastructure between delivery and spot on. That remains the major focus. There are still a couple of cities where we continue to run redundant infrastructure because we had lease lock-ins. We will continue to sort of combine those facilities. As an example, I took Pune as an example, similar situation in Chennai and a couple of other places. From a CapEx standpoint, I think typically our CapEx has come in at close to about between 5.5% and 6.5% of revenue. Over time, we expect that to stabilize at between about 3 and 3.5% of revenue, which will include both new CapEx for new sortation centers and new gateways that are being built, as well as maintenance CapEx for existing sortation centers and gateways. Great. I think that answers the questions that we have on chat, Rishi.
Thank you once again, Sahil, Sandeep, Amit, Varun, and the entire delivery team. You've spent well over an hour answering these questions, and also for this opportunity to host you on this call. We would also like to thank all the investors and analysts for your interest in the company and making this an engaging session. We can conclude the earnings call here. Have a good evening.
Thank you. Thank you all for joining. Thank you, Citi team, for hosting us.